Thanks for clicking. Rapid interest rate hikes are needed to break rising inflation expectations. This was the message coming from David Dodge, former governor of the Bank of Canada, in an interview conducted last week. The comments came during an interview with the Globe and Mail, where Dodge suggested that the Bank of Canada and the Federal Reserve must avoid mistakes that were made during the 1970s and during the 1980s, when we saw inflation rates and interest rates go to an all-time high.
I didn't ask you what you think.
When Canadians look at the current landscape, with Canada's inflation up to 6.5% and the US far ahead at 8.5% and rising, it's difficult not to imagine that Canada and the United States are going back to an interest rate environment of the 70s and 80s, where Canada's top prime rate hit 22.75%. So what I want to do today is go over Dodge's interview, where he discusses the differences and similarities between now and the 1970s and 1980s, discuss what Dodge says we should look for in the future, and then talk about what to look for next. Speaking of what to look for next, we are expecting to get April's real estate data out in a matter of days, which will obviously give us a good idea of how the recent interest rate hikes that we've had will be affecting the real estate market now and in the future. And we'll obviously have updates out on that on this channel. If you want to get those updates, click like and subscribe. But for now, let's get into this interview. So while the former Bank of Canada Governor David Dodge says that although things are different from now in the 1970s and 1980s, they're not very different. Indeed, there were three major factors which contributed to the 1970s style inflation rates. Those being increased public spending that contributed to high demand, tightness in the labor market, and an external shock. And yeah, I think we can safely say that all three measures are present right now as we see our inflation rate go up and up and up over the past few months. As Canada's budget even stated outright, our spending during the COVID lockdowns throughout the last 2 years has left our treasury depleted. Fun fact, as a side note, while the official budget states very clearly that our treasury was depleted, when Finance Minister Chrystia Freeland presented that budget, she left that phrase out.
The money that rescued Canadians and the Canadian economy, 8 out of every $10 invested, was deployed chiefly and rightly by the federal government. But our ability to spend is not infinite.
I'm guessing she didn't want the soundbite. Further, as our headlines have shown, we are currently in the midst of a national labor shortage, with 1/5 of Canada's working population set to retire soon. Granted, Dodge notes that the labor tightness that was characteristic of the 1970s was due in large part to labor disputes. It was still labor tightness nonetheless, and as we said, we are having a current labor shortage in Canada. And finally, oil. Massive increase in oil prices was the big contributing factor to the inflation rates that we saw in the 1970s and the 1980s. If we look at October of 1973, right before the oil shocks, oil was trading at $27 a barrel. By February, oil was trading at $61 a barrel, a 265% increase in a matter of months. Well, we haven't seen oil prices go that high yet. In January, oil was trading at $90 a barrel. And the current price as of this video is $105 per barrel. So not a huge increase, but definitely enough that Canadians are noticing at the pump, and definitely enough to contribute to our inflation rate. So when we look at the inflation of the 1970s and we look at the inflation rate now, we see these very similar three different pressures pushing up our prices. But the main difference, according to David Dodge, is that policymakers in the 1970s were late to the table. They didn't act to get the inflation rate under control, to change public perception, allowing the inflation rate to get into the public thinking. And Tiff Macklem has talked about this as of recent as well.
The lesson from history is that if inflation expectations become unmoored, it becomes much more costly to get inflation back to target.
So the concern is, and it always has been, and Dodge is reiterating this, if inflation starts to get unmoored, if it starts to play a central role in the public's thinking when they enter the marketplace, if they start to think that it's cheaper to buy goods now than it will be in 6 months, then we're going to get a big increase in demand, which will just create a self-fulfilling prophecy and cause our inflation rate to go higher. Ask yourself if you or your friends in the last little while have thought, well, I might as well buy this now because it's just going to cost me more in 6 months. I know I have.
Okay, thanks for the input.
Retailers love it, Central banks, not so much.
I don't like it.
And this is the type of thinking that Dodge says the Bank of Canada needs to get under control. They need to let Canadians know that they are willing to raise interest rates and raise them quickly in order to get the inflation rate back down to that 2-3% level. As such, Dodge says that the Bank of Canada should be looking at between 50 and 75 basis points rate hikes in June and another 50 basis point rate hikes in July, which would put us up to 2.25%. And that's just by July. We've talked before on this channel how 1.75% rates seem to be the breaking point, the point at which that many are predicting that Canadians cannot handle. So the central banks, the Bank of Canada, the Federal Reserve, Tiff Macklem and Jerome Powell, are definitely in a tough spot, with many, including David Dodge in this interview, calling on the Bank of Canada, on the U.S. Federal Reserve, to get control of inflation expectations so we don't see a repeat of the 1970s and the 1980s and the interest rates that followed shortly thereafter, while also trying to maintain economic growth, not cause a recession, if that's possible. Not cause a recession, this is going to be a very tough balancing act. And if Tiff Macklem wasn't going to be happy enough with his predecessor's advice in this column, Dodge doubled down and noted that you can see it in the body language of both Tiff and Jay Powell. They don't want to move such that they kill everything and create a bigger problem. They are nervous, and reasonably so. So according to David Dodge, the central banks, the Bank of Canada and the U.S. Federal Reserve, are very aware of the problem ahead and what a tough balancing act it is going to be going forward. If you raise rates too much, it could cause a major recession. If you don't raise them enough, inflation expectations get unmoored, and you head closer and closer to 1970s, 1980s style inflation and 1970s and 1980s style interest rates. But all of this is going to largely depend on the inflation rate. As we mentioned, the US is at 8.5%, Canada is at 6.7%, much higher than either country wants to be at. And we're going to be having more data come out on that inflation rate, on those inflation rates within the next couple of weeks. I would say that if we see Canada's inflation rate go to that 7.5%, then we are definitely going to be seeing a 50 basis point rate hike, and we could even see the Bank of Canada move into that 75 basis point rate hike if they're going to get inflation expectations under control. We'll obviously have updates out on that on this channel, and if you want to get those updates, make sure you click like and subscribe, and thanks so much for watching.